We're watching shares of TGT, Target, today after the company got an upgrade to buy from hold from Jefferies, saying headwinds for the retailer are mostly near-term problems. Jefferies senior research analyst Corey Tarlow joins us now. Corey, help us break this down, the thesis around this just being a near-term issue for Target. I mean, we walk in there right now, there's so much inventory that has flooded the store ahead of the holiday seasons. How are they going to be able to work through that?
Sure. So there are three key pillars to our upgrade today. The first one is inventory, as you mentioned. Second one is margins, and the third one's valuation. I'll start with inventory because that seems to be the most topical subject today. On inventory, our proprietary work illustrates that the headwind that Target and other retailers face might not be as bad as what people think. And why do I say this? Well, we've done some really differentiated work on this topic. So we looked at inventory cycles over the last 2 decades. And what did we find out? That when analyzing inventory growth and sales growth and profit growth throughout the last 2 decades, when inventory growth peaks, you tend to see a trough or a bottoming in sales and gross profit growth about 5 quarters after inventory growth peaks. And what are we seeing right now? Well, most of the retail coverage that I focus on is continuing to go like this. But for Target in the last quarter, we saw an inflection, right? Where we saw a peaking in inventory growth. So what does that mean? At some point between now and 5 quarters from now, you're going to see a bottoming in sales and gross profit growth and an inflection in the stock. And after talking with the company, Target only has a couple $100 million of excess warm weather apparel inventory. And you see this in our note today. We publish pictures of this in our store checks. And this is already in the guide that's already been reduced. Earnings revisions are now down, I believe, close to 40% in the last 9 months. And the balance of the inventory should improve meaningfully from here and skew much more towards consumables, which is still 45% of Target's business. So that helps to add a substantial layer of defensibility for this business in what are, frankly, as the CEO called it yesterday, unusual economic times. And he even cited that he's seeing some healthy spending trends despite the atypical environment in which we're in.
I'm glad you mentioned Brian Cornell because he made those comments here on Yahoo Finance at our All Market Summit, and I really enjoyed talking to him. But Corey, take a listen to this because I asked Brian about the inventory challenges they are having. Here's what he told us.
You know, back in June, we made a pretty bold and decisive decision. We said, all right, inventories have built up, consumer shopping habits have changed, they moved into different categories, and we said we're going to get out in front of this. So for Target, we put that inventory problem behind us, and now we can focus on great execution, delighting our guests, getting ready for the big holiday season. So we were pretty decisive and said, we're not going to just let this roll into the next quarter. We'll deal with it up front. And now we're excited that we're ready to play for the holiday season.
So, Corey, it's not just Target. I hear what you're saying on Target. And it sounds like just my vibe talking to Brian that they are working through this inventory. Maybe an issue that is going in the rearview mirror for them. But what about the broader industry? I mean, Walmart exited that second quarter with a lot of other inventory. Department stores, high levels of inventory. I mean, how big a problem is this going to be for the retail universe at large this holiday season?
It's likely going to be pretty significant in categories that are more discretionary in nature. And that's part of the reason that we are a little bit hesitant on certain discretionary retailers. But Target, frankly, is one where we see a lot of opportunity. And why? Well, let's take a look at the margin. For example, in that clip that you just showed, Brian Cornell talked about how they had cleared a lot of inventory in the second quarter. The business drove close to a 1% EBIT margin in the second quarter, which is rather uncharacteristic for a business that drives typically an EBIT margin over the last decade, close to 7%. So clearly, the last quarter was an aberration. And a lot of these self-inflicted or COVID-induced wounds are likely to lead to probably a subdued margin this year from an EBIT perspective. So probably around 4 to 5%. But as we look to next year, we think that a 6% or more margin would probably be reasonable. And I don't think that the street is quite yet focused on that, particularly given the near-term hurdles that exist as a result of elevated inventories in the environment that you point out, and holiday. But on holiday, what I would say is that we've heard from several retailers now that consumers are, while they're being more intentional, are still spending on holiday. So I was at a conference a few weeks ago. The CEO of Walmart US had cited a strong tailgate season, a strong back to school season. And then just a few weeks ago, the CEO of Costco had CFO, had mentioned that he's seeing sort of strong momentum in Christmas and Halloween inventory that has already hit the stores. So I think that does, despite the elevated inventory environment that we're in, bode quite well for the holiday season ahead.
Hey, Corey, it wasn't just Target that you are looking at here. You upgraded Target, but you still like Walmart also. And so it sounds like you don't think there's going to be a zero-sum situation here. Do you think Walmart is also going to be okay on the inventory front? And also, it sounds like you think they'll benefit from people maybe trading down and trying to save money a little bit.
Absolutely. So part of the reason that we do like Walmart is that it's a value leader and it benefits from a trade down. But beyond that, we took this a step further and we said, okay, if it's going to benefit from a trade down, how much do we see it benefiting over the next 12 to 24 months? And the reality is that we think that when we went through a really highly differentiated and unique analysis, that we think Walmart can drive over 100 basis points to its same store sales as a result of trade down in grocery. And that could drive upside to consensus comp numbers, not only this year, but next year too. And our estimates are above consensus this year and next year by over 3%. There's upside to valuation. This business is trading at 19 times 2-year forward earnings versus its historical average of 22 times. So it's trading at a 3-turn discount to historical average. And that range is typically about 17 to 27 times. So it's actually trading even toward the lower end of that range, which means that there's plenty of upside from not only a numbers perspective, but a valuation perspective as well.
Corey, thanks for joining us. Good to talk to you. Corey Tarlow is Jefferies Senior Research Analyst, talking to us about the retailers today. Appreciate it.